Roughly every 3 days, you make a money decision. And here's the wild part. Most of those decisions aren't great. Not because you're not smart, it's just your brain working against you. I'm Amr and I'll show you why. Here's what most people get wrong about money. They think it's picking the right stocks or the perfect strategy. But the truth? 80% of financial success is psychology. Just psychology. And in this video, I'm going to show you exactly how your psychology is costing you thousands of dollars every single year. Let me give you a real example. In 2008, during the financial crisis, millions of people panicked and sold their investments at the worst possible time. They locked in massive losses right before the market recovered. Why did they do that? It wasn't because they were bad investors. It was because of something called loss aversion, a psychological bias that makes losing $100 feel twice as painful as gaining $100. That one bias, that one psychological pattern, cost people hundreds of thousands of dollars. And here's the thing. You've probably done this too. We all have. You've probably held on to a losing investment way too long, hoping it would come back. You've probably chased a hot stock that everyone was talking about, only to buy at the peak. You've probably felt the fear of missing out when your friends were making money in crypto. These aren't character flaws. They're not signs that you're bad with money. They're just your brain doing what it's evolved to do, protect you from loss and follow the crowd. But when it comes to money, those instincts work against you. So what is behavioral finance? Behavioral finance is the study of how psychology affects financial decision making. It's the intersection of psychology and economics. It's the study of why we make the financial decisions we make. For decades, traditional finance was based on the assumption that people are rational, that we carefully weigh all the information, calculate the best option, and make logical decisions. But that's not how humans work. We're emotional, we're biased, we're influenced by the people around us, and behavioral finance is a field that studies these psychological patterns and how they affect our money. This field was pioneered by researchers like Daniel Kahneman and Amos Tversky, who won a Nobel Prize for their work on behavioral economics. They discovered something revolutionary. Humans don't make decisions the way traditional finance assumed we would. Instead, we make decisions based on psychological patterns and biases that often lead us astray. Richard Thaler, another behavioral economist, took this research further and showed how these biases affect investing decisions specifically. And what they discovered is that these biases are predictable, they're consistent, and most importantly, they can be overcome. Here's why this matters to you. Research shows that behavioral biases cost the average investor 2 to 3% in returns every single year. 2 to 3% might not sound like much, but let me put that in perspective. If you have $100,000 invested, that's $2,000 to $3,000 per year. That's $30,000 over 10 years. That's $100,000 over 30 years. And that's just from one or two biases. Most people are affected by 5 or more. So the question isn't whether behavioral biases are affecting your money. The question is, how much are they costing you? Now, there are hundreds of psychological biases that affect financial decision making, but there are 5 core biases that affect most investors. And if you can understand and overcome these 5 biases, you'll improve your returns dramatically. Let me introduce them. And subtle ding, SFX. Bias number 1, loss aversion. Loss aversion is the tendency to feel the pain of loss about twice as strongly as the pleasure of gain. In other words, losing $100 hurts about twice as much as gaining $100 feels good. This bias causes investors to hold losing investments way too long, hoping they'll come back. Panic sell during market downturns, miss out on long-term gains because they're afraid of short-term losses. The financial impact: investors with strong loss aversion underperform the market by 1 to 2% annually. Bias number 2, confirmation bias. Confirmation bias is the tendency to search for, interpret, and recall information in a way that confirms your pre-existing beliefs. In other words, you only see what you want to see. This bias causes investors to only read articles that support their investment thesis, ignore warning signs that contradict their beliefs, create echo chambers where everyone agrees with them. The financial impact: investors with strong confirmation bias make poor decisions because they're not seeing the full picture. They underperform by 1 to 2% annually. Bias number 3, anchoring bias. Anchoring bias is the tendency to rely too heavily on the first piece of information you receive when making decisions. In other words, the first number you hear becomes your anchor, and everything else is judged relative to that anchor. This bias causes investors to overpay for stocks because the first price they heard was high, hold underwater investments because they're anchored to the purchase price, miss opportunities because they're anchored to past valuations. The financial impact: investors with a strong anchoring bias make poor entry and exit decisions. They underperform by 1 to 2% annually. Bias number 4, herd mentality. Herd mentality is the tendency to follow the crowd and do what everyone else is doing, even if it's not in your best interest. In other words, if everyone is buying, you want to buy. If everyone is selling, you want to sell. This bias causes investors to buy at market peaks when everyone is excited, sell at market bottoms when everyone is panicked, chase trends and hot stocks, experience severe FOMO, fear of missing out. The financial impact: herd mentality is one of the most expensive biases. Investors who follow the herd underperform by 2 to 3% annually. And bias number 5, overconfidence bias. Overconfidence bias is the tendency to overestimate your abilities and knowledge. In other words, you think you're better at investing than you actually are. This bias causes investors to trade too much, thinking they can beat the market, concentrate their portfolio in a few stocks they're confident about, take on too much risk, ignore diversification. The financial impact: overconfident investors trade too much, pay too many fees, and take on unnecessary risk. They underperform by 1 to 2% annually. Now, here's the good news. These biases aren't permanent. They're not character flaws. They're just patterns of thinking that your brain has developed, and patterns can be changed. The research shows that when investors understand their behavioral biases and implement specific strategies to overcome them, they can improve their returns by 2 to 3% annually. 2 to 3% might not sound like much, but remember what that means over 30 years? That's $100,000 on a $100,000 investment. That's life-changing money. On this channel, MindVist, we're going to dive deep into each of these 5 biases. You'll learn exactly what each bias is and how it affects your decisions. Real-world examples of how these biases cost investors money. The science behind why your brain does this, specific. Practical strategies to overcome each bias. How to build a systematic investment process that protects you from these biases. And most importantly, you'll learn how to improve your returns by 2 to 3% annually without changing your investment strategy, just by changing your psychology. If this resonates with you, I'd love for you to subscribe to the channel. We're publishing new videos every Monday, Wednesday, and Thursday, diving deep into behavioral finance and how to improve your financial decisions. And I promise you, understanding your behavioral biases will be one of the most valuable things you learn about money. But here's what I want you to do right now. I've created a free behavioral finance starter kit that includes a 25-question assessment that identifies your personal behavioral biases, a personalized bias profile showing which biases affect you most, practical worksheets for overcoming each bias, a 30-day action plan to start action, improving your returns immediately. This is completely free, no credit card required. Just click the link in the description, enter your email, and I'll send it to you immediately. And if you want to go deeper, I've also created a community where we discuss behavioral finance, share our experiences, and hold each other accountable. It's a place where people who are serious about improving their financial decisions come together. The link to join is also in the description. But most importantly, I want to hear from you. In the comments below, tell me, which of these 5 biases do you think affects you most? Loss aversion, confirmation bias, herd mentality? Let me know in the comments and I'll respond to as many as I can. In the next video, we're going to dive deep into loss aversion, the most expensive bias for most investors. You'll learn exactly why you panic sell, how much it costs you, and the specific strategies to overcome it. So make sure you're subscribed so you don't miss it. Thanks so much for watching. I'll see you in the next video. Master your mind, master your money.